Hello and welcome to Real Estate Essentials, brought to you by Ambition. We know the Federal Reserve is the country's central bank, yet most of us don't understand the role the Fed plays in the economy or the real estate market. Our guest today is John Mondragon, Senior Economist, Federal Reserve Bank of San Francisco, to answer some of our questions. John, it's great to have you with us.
Thanks very much for having me. I'm delighted to be here.
How has the pandemic impacted the real estate market today, John?
So it's been extremely varied and extremely interesting across a wide variety of markets. I think you really have to think about the different segments of the real estate market because the impact of the pandemic has really varied. So it's pretty clear that commercial real estate in major urban areas has been deeply affected with like large vacancies. As people are moving into remote work or have moved into remote work over the pandemic, you've seen huge changes in the commercial real estate valuations and the rents that they're able and willing to charge. I think the big question there is going forward, how as the economy responds to the vaccination campaigns and people are coming back into the offices, are they going to be coming back into all of the offices they used to occupy? We're still waiting to see that. I think in the residential real estate market, there have also been huge effects that were very, very different. So it is true that in some of these really big urban centers like New York, San Francisco, you've seen people moving out and rents and prices not being as elevated in other places. But broadly, there's been huge activity in the purchase market, large increases in house prices pretty much across the board in the country. And so actually what it looks like is there's been a huge demand increase in residential real estate for most markets that we're looking at.
Sure. Well, speaking of the residential housing market, this market has outperformed astonishingly the grim forecast from earlier this year. How did that come about?
Yeah, it was. I was one of those people thinking that we were going to see some pretty, not exactly 2008, 2009, but some pretty bad outcomes. I think it's been a number of things, and they're all super interesting. It's hard to tell which has been most important, but we can go through them because I think they're all very important. One thing we talked about a little bit in that there's been this shift from people who have wanted to rent and live in city centers to either moving very far away to less dense areas or moving to nearby metro areas and wanting to live in larger single family houses. So there's been a relative demand shift that seems to have shown up in increased prices in these housing markets. The other big thing is that there's been a huge and very rapid decline in interest rates. As we entered into the pandemic in March of 2020, there was a really large decline in interest rates from the Federal Reserve Bank, and that's propagated through the economy and lowered mortgage rates that a lot of people are facing. That's also led to a large increase in their willingness and ability to pay for houses. Other things that have been important, I think, is that a lot of people, we really worried that as you saw unemployment skyrocket during the pandemic, that was going to lead to a lot of foreclosures or at least forced sales as people were unable to make their mortgage payments. And I think a number of the policy responses have been really important for reducing that likelihood. That unemployment insurance has been extended and been generous enough that people are able to cover their payments, and that's prevented a lot of forced sales. We'll see what happens as those policies scale back. But the stimulus, the various rounds of stimulus have almost certainly helped reduce kind of people who have to sell or who end up in foreclosure because of their inability to make their payments. And so I think all of these things have been important for explaining why housing markets have been much more resilient than we were expecting, why we didn't see a large decline in house prices.
Sure. We know that the Fed studies institutions that supply mortgage credit to both households and businesses. What do your findings tell you about the current state of the lending market?
Yeah, there have been some really big changes, I think, along the lines that you might expect given the size of the economic shock that we've all gone through. The unemployment rates were skyrocketing at unprecedented levels in the early pandemic months. And so as best we can tell, and what we've seen consistently from say February, March of 2020, even until now, is that credit standards seem to be really tight across the board, particularly in residential, but also in commercial credit lines. So what that means is that if you look at the home purchase market or you look at the refinance market, the kinds of borrowers that are getting credit tend to be the highest kind of quality borrowers in terms of default risk, right? The borrowers who have pristine credit history, who have lots of cash available for down payments, who don't have any sort of spots in their recent credit record. Mm-hmm. This makes sense. I think there was a lot of economic distress in the economy, and lenders looked at their risk and were very unwilling to take it on, or at least much less. The standards seem to be the tightest that they've been maybe since 2013, 2014. Mm-hmm. And these risks, part of it is there were these forbearance policies that were implemented to try and make sure that borrowers who couldn't pay because of the pandemic didn't lose their home. But even without that, the unemployment increases were the primary risk.
Speaking of forbearance, will borrowers exiting the mortgage forbearance programs, will that lead to a spike in foreclosures in the near future?
It's a really important question, and we're all waiting, I think, to see exactly how it's going to play out. The question I would think about is, well, I would think that foreclosures are relatively lower risk, but primarily because the house prices have remained so elevated, right? Typically, you're only going to see a foreclosure if the borrower doesn't have the equity in order to just be able to sell the home and kind of move into a cheaper home or a rental. And so that's one of the really big differences between this recession and what we saw in 2008, 2009. 2008, house prices had collapsed. And so lots of borrowers couldn't walk away. And so they had to enter into the foreclosure process. I think what we're seeing now, because house prices have increased strongly, right, have not fallen, is that borrowers who are not able to make their payment are typically going to have the option of selling their house and walking away, as opposed to entering into foreclosure. Now, the question is, if a lot of these borrowers have to do that at the same time, are you going to see enough inventory come online that house prices might end up, slowing or maybe even falling? But that, I think, it's a big question. That would take a lot of inventory to see that happen. But it's an important thing, and we're not exactly sure how it's going to play out, given, how many borrowers, when they exit forbearance, are going into, have already landed back at their job.
Mm-hmm. What's the current level of mortgage debt outstanding in the country, just approximately?
So, yes, it is large. So most numbers are going to give you around $10.4 trillion in outstanding mortgage debt. The U.S. housing market is one of the largest housing markets in the world.
That's a big number. Now, how does that compare to 10 years ago, John?
So actually, it's interesting. It's not that different if you just look at the nominal number. That is, if you don't take into account any change in inflation over the 10 years and now. In terms, if you actually think about the fact that we've had, pretty moderate but sustained 2% inflation over this last 10 years, it's actually a much lower number in real terms. And so there's a lot of interesting things that might suggest about, what the position of the economy now relative to 10 years ago.
What does this change, or actually lack of change, suggest to the health of the economy?
Yeah, I think there's a number of things going on that are super interesting. So typically, I think we would expect, and what we've seen if you look over a longer run of the US, the debt increases pretty naturally in the household market as the economy grows. Now, in mid-early 2000s, I think we saw, and most economists would say this, pretty unhealthy expansion in credit supply. A lot of people getting very strange types of loans, and loans that they weren't going to be able to pay back realistically. And so there's probably, a much higher increase in debt and a debt load than we would normally like to see. And we saw the implications of that in the financial crisis. So coming out of that and looking now and saying 10 years later, we've seen not the kind of increase in debt that we might expect, as the economy has grown substantially since then from that recovery. That one could argue, and a lot of people have, that there's been a real tightening in credit standards that has not loosened very much since the financial crisis. And so I think there's interesting discussions to have about credit access and what it looks like now as we recover from another recession that we know has really affected borrowers at the lower end of the income distribution, and where those credit standards should be to look like a healthy kind of economic recovery.
Sure. Given the level of mortgage debt outstanding, what's the resiliency of the banking industry to a sudden real estate price decrease?
Yeah, super important question, one that the Federal Reserve is very interested in. And so it's, hard to say exactly how any industry would respond to large price increases, but what I can say with a lot of confidence is that there were a lot of lessons learned from the financial crisis, when the collapse in house prices really stunned everyone and caused a huge amount of distress in the mortgage market and in the banking industry broadly. So a lot of the changes that have been made have been for the better. So I think what we've seen, even though there have been a lot of defaults and forbearance, the use of forbearance in the mortgage market, we haven't seen that extend into instability in financial institutions. And I think that reflects that there's been a lot of healthy regulation of financial institutions leading up to this recession, and that some of the things that we put in place, like Dodd-Frank, have done what they were supposed to, of make the banking industry resilient to a large shock, so that it doesn't propagate further and make things even worse.
Sure.
Fannie and Freddie have been under pretty tight oversight, and so they are continuing their function so that the mortgage market doesn't collapse. And I think that basically what I would say is that we are in much better shape now to a large decline in house prices than we were entering into 2008, 2009.
Well, compared to 2008 or that period, are consumers and small businesses, for that matter, better positioned to withstand a sudden price adjustment in the real estate market?
Yeah, so I mean, relative to what we were just saying, that we haven't seen the debt increases that we normally would have expected with the kind of growth that we've seen. The answer, I think, would be yes, that borrowers who've been in the market now, in the mortgage market and in the commercial market, have come into the market with more cash on hand. That is, their loan to value ratios, their down payments have been healthier than they were in 2005, 2006. And so their payment levels have been lower. They haven't been as likely to be in non-traditional mortgage products where, the mortgage payment is going to be adjusting sharply, unexpectedly, and causing some sort of payment shock for borrowers. And so I think that's been a big reason why we haven't seen as much distress as we have. But then the other thing going back is the policy response to this COVID recession has been much stronger from the beginning than it was during the financial crisis. And this isn't to say that policymakers were better or worse at in either of these situations. It's mostly, I think, that we've learned a lot of lessons from the financial crisis, and we've used those lessons to kind of make sure that this recession isn't as deep or as long as what we went through in 2008, 2009. Sure. And so those borrowers, even if they're not better positioned, are going to have access to policies that borrowers in 2008 and 2009 didn't. Say, really generous forbearance policies, longer unemployment insurance, that sort of thing.
Sure. Well, given the uncertainties in today's economy, do you think that we may see some type of financial crisis in the near term?
So I guess the thing that comes to mind thinking about this question is how surprisingly, to me at least, how resilient we have been throughout this really large COVID shock. So this was an extraordinarily fast increase in unemployment and a really huge shock to so many businesses, right, in so many different sectors. And it was really, watching these numbers come in was really staggering, and just
yes.
You have flashbacks to the kind of collapse that you saw in the financial crisis. And then, sitting a year out, there have been a lot of really important policy efforts that have gone into this, and a lot of hardworking people making the right decisions for themselves at different stages. But we've weathered this in a way that I'm really surprised that we've seen as little disruption. If you just think about the real estate market, as we could have. I really, when you saw the size of the shock in March, I personally was expecting, something more like devastation in a lot of these markets. And I think what we've seen is not that. And there's still a lot of work to be done. There's still a lot of people who don't have jobs, who had jobs before and who want those jobs. And so the recovery is definitely still underway. But right now, I think the cause for optimism as these vaccines are rolling out and such is pretty high, I think.
That concludes today's program. Thanks to our guest, John Mondragon, Senior Economist from the Federal Reserve Bank of San Francisco. I'm Gary Barnes, and I'll see you next time on Real Estate Essentials, brought to you by Ambition.